This is Ag Matters PM from the Iowa Agribusiness Radio Network, your daily recap of the information that affects Iowa's farmers, producers, and consumers right here in the heart of the heartland. With reports from our award-winning team of Dustin Hoffman, Riley Smith, and Mark Magnuson. Now, from the IARN studios in Des Moines, here's Dustin Hoffman.
Welcome to Ag Matters PM from the Iowa Agribusiness Radio Network. I'm Dustin Hoffman. We're going to look at those markets coming up here very soon, especially with the WASDE report coming out today. But first, we hear from Iowa Renewable Fuels Association Executive Director Monte Shaw. He talks about the state of the ag economy, and while a lot of people are trying to compare it to the 80s, he thinks that if we're in a farm crisis, it's all in lowercase letters, not uppercase letters. And back then, biofuels gave us a way out of the situation, and he's convinced that it could do it again.
Now, many of you have probably heard me tell the story of how I came of age during the 1980s farm crisis. It was not a fun time. But I remind people that we really actually never got out of the oversupply problem until the turn of this century. Now, what did we do? We created farm programs trying to stabilize the market, but sometimes those came at a great cost to rural economies. And then in the 90s, well, farmers often farmed at a financial loss and then were made whole by going to a trip to the mailbox to get a government check. That was not what they wished for, but it was the reality they faced. It was the growth of renewable fuels at the turn of the century that created the market demand that not only absorbed that excess productivity from the 80s and 90s, but it grew along with the ever-increasing productivity of farmers for 2 decades this century. And it was a great time to be a farmer. So, the good news is over the last 20 years, we made E10 the normal fuel, the standard fuel in the country. The bad news is sometime around 2018, we actually saturated the E10 market. But our farmers never stopped being more productive, and that's why we're here today. Today, the supply of corn is growing at probably about 3 to 4 times faster than the domestic demand is growing for corn. So, to put a point on that, I guess I would say, consider that Mother Nature in 2025 threw a few curveballs, a few monkey wrenches at our farmers, and how did they respond? Just by producing a 17 billion bushel corn crop, 1 billion bushels more than the largest corn crop ever before. And with corn ending stocks now back around 2 billion bushels, it's not hard to see why prices are back under the cost of production for many farmers. So the question we have today is, what are we going to do about it? When you have a supply running above demand, in my mind, there are 3 options. First, you can reduce supply like we did in the 1980s. We idled a significant portion of our productive land to address the problem. And while it might have stabilized the price of corn, for those that were still farming, it forced thousands of farmers off their land and left entire counties bereft of economic opportunities. And unfortunately, if you look at the USDA long-term outlook, what do? They hold the price projection for corn right above $4 for the next 10 years. I might note that is still below their estimated cost of production during that decade. But how do they do it? If you flip the page and dig into it, they do it by reducing acres by 10%. So I stand here today and I say that is not a good solution. We do not want to force thousands more farmers off their land. Now, the bottom line is that reducing supply may raise the price of corn, but only for the farmers who survive to enjoy it. And the overall economic impact of less corn production is hugely detrimental to the Midwest states and to their economies. So, the second way that you can try to address this supply-demand imbalance is to do what we did in the 90s, and that is with massive farm bills. Now, let's put aside for a second that no farmer actually wants that. But consider that today, the challenge of balancing that market might cost a farm bill $20, $30, $40, maybe even $50 billion a year. I don't think the U.S. can afford that, even if there was the political will to do it. So no, we need to go back to that third option. It has worked before, and it can work again. Now, I suppose it's fair to ask, is there actually a demand solution to the problem we face? And to that end, the Iowa Renewable Fuels Association, along with the Iowa Corn Growers, we commissioned a study by prominent economists to answer that very question. Now, the good news is the economic study found there are actually plenty of demand options for renewable fuels that will grind up corn and crush soybeans if only we have the will to go get them. These markets are not going to be handed to us. They are going to require new tools and new technologies that, even as we speak, are often under attack right here in the Midwest. The study found that replacing E10 with E15 as the new normal for U.S. gas tanks would create enough new demand to balance that corn supply at a profitable price point for several years. So that is our most urgent effort. Having said that, the study found that E15 is not enough does not create enough demand for the next generation, for the next 20 years to keep up with farmers. So while E15 is immensely positive for the next 5 to 10 years, however long it takes to phase that in, it just as importantly buys us time. It buys us time to develop the larger markets that we need to drive agriculture for the next generation and beyond. But I don't want anyone to leave here today thinking that if we just get E15, all of our problems are solved for the next generation. It is the vital first step. Now, the good news is, with that time from E15, there are massive new markets out there that are looking for the very solutions that renewable fuels have to offer. The marine industry represents an 80 billion gallon a year opportunity. And the worldwide airline industry by 2050 is expected to need 150 billion gallons a year of fuel. And they are asking for our help. They're asking us. Now, the trick is, to be attractive to those markets, we must lower the carbon intensity of our fuels. If the marine industry is going to pay more to replace their dirty bunker fuel, which is also dirt cheap, with low carbon alternatives, then every single point of CI reduction makes ethanol and biodiesel more attractive. Again, if the airlines are going to pay more for sustainable aviation fuel, then more carbon reduction bang for the fuel buck is what's going to be successful. Now, I cannot overemphasize how massive these new markets are. If renewable fuels can provide just a portion of those low carbon needs, it could drive demand for farmers for the next 20 to 30 years, even when accounting for that never-ending productivity increase of American farmers. Now, I also think we need to be honest with ourselves. We are not the only people looking with wide eyes at those new large markets. Brazil, China, India, and many others are rushing to put themselves in a preferred position for those markets. And at the same time, our competitors are moving forward. We find ourselves fighting a defensive action simply to protect the ability to use the tools and technologies necessary to produce ultra-low carbon renewable fuels. Tools like carbon capture, use, and sequestration, CCUS, and regenerative agriculture. So let me take a moment here. I want to pause just a second, because this is something sometimes people don't fully understand. And I want to talk about that phrase, ultra-low carbon. Now, I would assume, there's some pretty bright lights in my eyes, but I would assume out there that there are probably some of you in this audience who think that carbon emissions are an existential threat to the future of the human race. If I was a betting man, I would assume that there's probably even a few more people out there who actually don't really care about carbon emissions, and maybe some who even think it's some kind of government hoax just to control more of our lives. I want to say to you all today, I don't care. I don't care. Now, I'm not trying to be rude. What I really mean by that is that our personal political viewpoints on carbon are irrelevant to these massive new markets. We have customers willing to pay us for ultra-low carbon renewable fuels. It is simply good business, not politics, that drives our desire to produce those fuels. So as we work on policies that are going to move our industry forward, to drive demand for corn and soybeans, and to return the rural economy to a path of prosperity, please leave your politics on carbon at home. So much is at stake. We only seek to provide the products that our customers want to buy. If petty politics ties the hands of American producers, our competitors will be more than glad to step up and take those markets. And today I do think Midwest agriculture is in a crisis. I still think it's a small C crisis. However, I do fear that if we continue to ignore the fundamental supply and demand metrics out there, and we don't move rapidly to pursue these new markets that I just talked about, and we don't pursue the tools and technologies necessary to get them, I fear that in a few more years, we're going to see the crisis of today turn into a capital F, capital C farm crisis. And I don't want to go back there.
That again was Iowa Renewable Fuels Association Executive Director Monte Shaw. And it's time now to turn to the closing markets. And we're being joined by Jason Meyer of agmarket.net. Jason, we got the WASDE report for February, not usually a big earth mover. What did we see come out of that report today, and how did the markets react?
Yeah, today the action was mixed here. We had the USDA report come out at 11. And if you're a corn bull, you got to be a little bit disappointed. We lowered ending stocks 100 million bushels. We had the world carryout on corn dropped 5.4 million metric tons, and we could hardly muster any rally here today. So a lot of headwinds in corn as we continue to go forward. Then on the bean side of the ledger, that was a pleasant surprise. There was absolutely no changes to the U.S. Balance sheet. The government actually did increase the Brazilian crop 2 million metric tons and left Argentina's alone. But we're seeing some good demand for soybeans stemming from the ideas that maybe China's going to come by and buy some more U.S. soybeans, although we're higher than Brazilian destinations. Also, there's some enthusiasm about the RVO that might have some traction, and that would be friendly for the soybean oil. And then you talk about India. We're looking at maybe signing a trade agreement with India where they would remove the tariff on soybean oil from the U.S. So that would be a positive development for the soybean market.
And then moving on to the livestock side of things, cattle and hogs. Cattle had a decent day yesterday. Hogs a little bit more backtracked. What did we see come out of the livestock today?
Livestock markets were under a little bit of pressure. I think we got a little bit of technical selling. You look at hogs, the funds had close to an all-time record long position in the market. I just think that market just needs some positive news to continue to rally. Then you can step back to the cattle market. The idea that the USDA opened up a new screw worm fly facility in South Texas maybe is putting a little bit of pause to the bulls, and maybe we'll see the border get open sooner rather than later, although I still think we're a long ways away from that occurring.
All right. Well, Jason, if folks want to talk about some of the information you shared and we get some ideas of what they should be doing with their marketing strategies, what's the best way for them to get in touch with agmarket.net?
The best way, like you said, just go to our website, agmarket.net, and reach out to one of our profiles. You'll find our cell phone numbers, and we'd be happy to hear from you.
All right. Jason Meyer from agmarket.net's been our guest here today. Jason, thanks so much for the insight. We'll talk to you again soon.
Thank you, everybody. Have a great day now.
And that was our market analysis and WASDE recap from the folks at agmarket.net. Let's go ahead and take a look at the closing numbers on the Iowa Agribusiness Radio Network market screen. At the close, March corn is unchanged at 4.28 3/4. March soybeans up 11 3/4 at 11.22 1/2. Soybean meal up $3 at $300.80 per ton. Soy oil up 58 cents at 57.27. Chicago wheat down a half at 5.28 1/4. Kansas winter wheat up 1 3/4 at 5.30 1/2. Kansas spring wheat up a penny at 5.67 even. Minneapolis spring wheat down 2 1/4 at 5.68 1/4. Oats up 3 1/2 at 3.02 1/2. On the mark, live cattle down 20 cents at 239.10. Feeders down 267 at 364.77. Lean hogs down $1.22 at 95.50. Pork cutouts unchanged at 103.40, and Class 3 milk is 6 cents under at 15.16. Of the closing markets, and that is the end of today's show. You can find all our content online at iowaagnet.com. From the IARN studios in Des Moines, I'm Dustin Huffman. For Riley Smith and Mark Magnuson, we thank you for watching. This has been Ag Matters PM.